Hello guys, it's ETMFX, and in this lesson we're going to cover what inducement is and how to find the correct inducement and how to use it in your trading. So what is liquidity inducement? Liquidity inducement is an act of when liquidity is being engineered around the area of where price actually wants to go. It's basically that price is hovering around the area where price actually wants to go, so it doesn't go there directly. It hovers around it. Prior to approaching the zone or the level where price is intended to go and transact orders, which would be your order fulfillment, it needs to make a few stops, which are in form of inducing traders to make a mistake and force an early entry. Price will react from a level or a zone nearby the intended level or the zone to entice traders into taking positions. So here we have our level that the institutions intend to sell at. So this decision has been made prior to the reaction. And we would call this our POI, our point of interest. Why is it our point of interest? Because this level is more than likely a supply candle, which would be an order block, or let's say a high resistance level or a gap. It's a level that we anticipate price will react from in the way we trade, which is smart money, right? So we anticipate price to react from this level. But price wouldn't just head directly to that level. It would cause an inducement, which would be in a fashion of price would get close to the area. So as you can see, this is our level. Our level starts right here. Price would get close to the level and come back down. Get close and come back down. Get close and come back down. What is happening here? It's trying to entice traders into taking sell positions earlier than the initial point of interest. Why? Because as let's say the first swing happens, nobody sells. The second swing, you're like, okay. And it might even come in the form of a stop hunt, which would be even more enticing. You're like, okay, it might be time to sell the market. So as all this is going on, liquidity is being built here. Stop losses are being placed. Stop losses are being placed. So then later on, price will fake react from our inducement area and drive up to the price and react from our initial point of interest where the markets actually intend to sell at, and then price will sell off. So it will take out all the stops, cause the actual stop hunt, which would be the reaction from our point of interest, and then react. So what occurs during an inducement? Liquidity will be built via retail trader stop losses and false breakout traders, especially for scalpers who dominate majority of the trading market in the retail world due to not being patient and wanting quick results. So it's basically the market capitalizes on traders who are trigger happy. And if you think about it on a micro and a micro level, on a macro and a micro level, a 1 hour consolidation, which could be close to your POI, which would be your inducement, on a 1 minute time frame, that's multiple ranges. That's over 50 ranges on a buy to a sell, on a buy to a sell. So believe it or not, somebody's out there trading this and the market capitalizes on it. This prints on the chart as a liquidity grab, where the stop hunt takes out the stops and proceeds to the level institutions intend to buy or sell at, which would be your POI. So here we have our point of interest being built. So let's, for hypothetical senses, let's say this is a supply candle, a order block, a sell order block, right? So price drops down, and as price is trying to make its way back to this level, it's starting to consolidate and acting as if it's going to react from this level. While that happens, that builds liquidity. So then price comes out, stop hunts the liquidity, takes the liquidity, and reacts from the point of interest, right? So it's a stop hunt that we know where to anticipate the reaction from. But prior to that, you need to see that the liquidity's been built. And this segment right here, this is what we call an inducement. It comes from the word induce. It's inducing traders into taking sell positions. Let's say people try to take sell positions here, here, thinking the market is going to sell just because of the market reacting over here, just for price to come up, stop hunt them, use the POI as a catalyst, and drop down. So let's go over this example. And again, if you're a trader that's been turning inducement, I know exactly what question you have in mind. How do we pick the correct point of interest? Don't worry, we'll get to that. But first, let's cater to the beginners. Here, the point of interest has been formed, which would be your order block. So the order block has been formed and we're tracking this area. So as price reacts from this order block, of course, a validated order block that broke structure and had a strong reaction from here, price came close to this area, but did not react directly from our point of interest. It reacted from an area close by, like we said. Price will react from an area nearby your point of interest and gave you a convincing reaction. So this would be your convincing reaction. So now that we had the convincing reaction and the fact the price came close to our point of interest but did not react directly from it, we would call this an inducement. So this will be your liquidity build. So now what we're expecting price to come down, take out the stops, form the stop hunt while reacting from this level and continue higher. And as you can see, that's what happened here. Price took out the liquidity, forced the stop hunt, reacted from our order block, and continued higher. So let's go over this example. We have a validated order block. And you guys know why it's validated order block. No need to waste time to explain this, but we're waiting for a reaction from this order block. What would this order block be? It will be our point of interest, right? So we're waiting for price to come up here, get a reaction, and continue lower along with the downtrend, right? So let's see. As you can see, price reacted from a level close to our point of interest. So as you can see, it got close, but not really. So we can start considering this as an inducement. Reacted again. This is even more convincing. So now all our checklists are complete. So now we are just waiting for price to reach our point of interest. In this case, would be this order block for price to react and continue down. So this would be the inducement phase, this entire thing. A lot of orders got stuck in here. Retail stop losses got taken. Many tried to take a short position during this consolidation, especially, like we know, scalpers, just for price to come up, stop hunt them, use our point of interest as a reaction, and continue lower. So let's get to the advanced part of this lesson. What are the inducement criteria? The most important thing when identifying true inducement is that it's occurring at fair price. Price is going to fair price to balance books and keep options open is key to an inducement. Before reacting from a price extremes, expect inducement at fair price. So what are the price extremes? Obviously premium and discount. And why would they keep options open? What I mean by that? What I mean is if price is a fair price, which would be the 50% mark, price can go either way. So there will be no losses taken as far as institution goes. It's cheaper way to move the market when price is at fair price. Let me explain. So let's say this is our premium level and this is our discount level and this is the median, which would be our fair price. So price will cause the inducement around the fair price area. Why around the fair price area? To keep options open, because when you're in the middle of the range, you can go either way and it'll be a lot cheaper for the institutions to move price from fair price instead of forcing an inducement and premium just to take it to discount or from discount to take it to premium. So price will cause the inducement right here and then go to your, let's say, demand zone, which would be your demand order block, or let's say price is inducing right here, reacting from our 50% just to react from the premium and come down, and this would be the stop hunt. So here we have our discount level, then here we have our fair price, and here we have our premium. And again, for everybody asking me about these settings, there's nothing special about these settings. It's 0, 25, 50, 75, 100. It's Fibonacci broken into 4 segments. It's a Fibonacci tool that's free on TradingView, on MetaTrader. It's easy to find. So price forced the range. So we put our ranges, we put our Fibonacci on our range. So now what are we looking for? We have our institutional candle, which is in our discount area. Like you guys know, we always buy in discount and sell at premium. Price comes down, reacts with the fair price once, twice, 3 times what happened as price is reacting here? Liquidity is being built. So when price drives to our point of interest, that's in our discount area, price will come here, take out the stops, force the hunt, and react from this level. And this example right here is this example without the Fibonacci and adding more context. So here we have our institutional candle. Liquidity was built via 50% inducement. This will be our inducement. That's again happening during our fair price. Price comes down, takes out the stops, which takes out the stops right here, and reacts bullish. Reacts from what? From our order block. So let's go over another example. So again, why did we place the range here? Because as you guys know, I covered ranges multiple times. And this is our low and this is our significant high, right? Prior to this range, this was the previous high and this was the low. Like we know, internal, external liquidity. Always go back to my old videos for reference, right? So as you can see, prior to this movement, price already reacted from our fair price. So price came back down and reacted again. Doing what? Forming the inducement. So liquidity is being built right here around this entire area. Liquidity is being built. So what we're waiting for is price to come down where? To our discount level. So as you can see here, price reacted from this institutional candle. What I would be waiting for if I'm trading inducements, I would wait for an order block that's in the discount area, just because of the lower risk parameters, right? But in this case, price still induced, forced the stop hunt, and reacted off this institutional candle, which is still close to the discount area, but it's not ideal. Ideally, you would always want your order block to be in your discount area if you're buying, or premium if you're selling. Let's go over another example. Well, here we have a mid-quality setup. And why is it mid-quality? It's not because the stop hunt reacted from this area and it dropped down a little bit and eventually it failed. It's not because of none of these things. It's not even because this is hindsight. The fact that it only reacted a little bit right here and then continued going up. This reaction is still valid to a certain extent, but it's not the highest quality inducement trade. Why? Because when you pull out your Fibonacci level, you go to your high and you go to your low. As you can see, it did react from our what? Premium level. It did. But look at the inducement. The inducement should have been here or maybe a little bit higher than our fair price. It should have been around our fair price. But this inducement was closer to the premium level than the fair price, than the 50%. It was closer to the premium level. So the fact that it was closer to the premium level, it makes the setup a bit weaker. And that's why you only had a small reaction just for price to later continue. Why? Because as we know, there's sell orders here, sell orders here, sell orders here. So the fact the price got close to them, a lot of these orders end up being used already. So by the time price does come to use this area for more sells, there's not enough power to fully drag price down. This is what would make an invalid inducement setup. This will make actually the worst inducement setup. We shouldn't even call it an inducement setup, right? So let's say your point of interest is in premium. So let's say you have an institutional candle right here, you have an order block right here, and you're waiting for price to get there. So let's say price drags down and you're waiting for price to come back and revisit that level. If the inducement starts happening around the premium level, that's no longer an inducement. That's a reaction from our institutional candle. So at this point, if price drops down and comes back again, it's more than likely to continue bullish, right? So, and what's the reason for that? We know that there's orders in this candle, and like we know, institutions sell in premium and buy in discount. So they already sold here. The orders that were here already got used to drag price a little bit down. So if price comes back up here, this is no longer an inducement liquidity built. Because why? Because it reacted from our premium level. There wouldn't be enough orders for price to take more orders here and then continue down. This would be done because the orders got used for this tiny move. Get it? Let's go over this one more time. Again, we have our candle right here. Price drops down, and we want what? Price to visit our point of interest, right? Our point of interest is this candle. If price goes up and starts reacting like this around our premium area where our point of interest is, if price revisits this area one more time, even if let's say this institutional candle is somewhere here, it's in a deeper level of the premium level. The fact that it touched the premium range, there's no longer any orders in this candle because this candle is responsible for this whole area. So if price starts acting in a fake inducement manner, if price comes up here, it will continue up nine times out of 10. So be careful. Like I told you guys earlier, the best inducement is when it happens in fair price. The medium quality would be when it happens not super far from the fair price, but not super far from the premium either. And the worst kind, which is invalid, would be when it happens in the premium area. And likewise, vice versa. You don't want to have an institutional candle here and for price to come up here, and thinking if it's going to come back down here one more time, it's going to use this liquidity. This is a no. If price comes back to this level one more time, it's more than likely to continue lower. So why did this order block fail? Why did this order block fail? Easy. If you pull out your fib, you get your levels, high to low. Look at where the inducement is. Look at where the inducement is. The inducement was where? In our premium level. And like we said, most of our inducement should be in our fair price. The fact that this inducement is in the premium level, there's no more orders here. So even if price does eventually come back to your order block, this is invalid. There wouldn't be enough orders in this order block to sustain a reaction and drop price lower. Why? Because this was already used. Price already came to the premium area and dropped all the way down. The move from this order block, any sell orders that were in this order block were already used in this reaction right here. Get it? So a majority of the time from the inducement, you can find out if your point of interest is going to work or not. Last time before we end this lesson, focus on mostly, if not only, trading the highest quality of inducement setups. And this right here is the highest quality. Why is it the highest quality? Because if you pull your range, the last significant low that's surrounded by a low and another low, and then the last significant high, you pull the range, and what do you see here? What makes this an ideal inducement setup? One, your order block, which is right here, it's located in our discount area. And yes, it's not all the way in the discount area, but majority of it is. And ideally you would want it inside of the area somewhere. The deeper the better, but a lot of times it doesn't really drag that deep, because if it passes, let's say, the 25% of the discount area, it's more than likely you lose the trade and price will continue bearish. So here you have an order block that's located in the discount area. You have your inducement right here. And where did your inducement occur? In the fair price. It didn't happen here. It didn't happen here. It didn't happen close to the discount area. It happened in or around the fair price. So as you can see, the inducement occurred in the 50%. 1 second. So now what you're waiting for is for price to take this liquidity. Price to come down here, take this liquidity, force the stop hunt, use your order block that's in your discounted area, and continue bullish. At least take out. So what happened? Price reacted from your level right here. It did not leave the range. Price reacted from your what? Discount area. What was located in your discount area? Your point of interest. And price went back to premium. And like I taught previously, from discount to premium, premium to discount. And the inducement is always when in fair price. Yeah, guys, make sure you like, share, comment, subscribe, everything, and drop in the comment what do you guys want me to cover next. I'm gonna try and continue this two videos a week thing. It's getting really difficult to produce quality content twice a week, but I'll keep on trying as long as you guys give me ideas. Thank you.